Good morning, everybody. Mark, Solon and James Tully here from Symmetry Financial Management for our September investment update. The idea behind the monthly sessions, which we're going to do going forward, is to give you a snapshot of where we're at based on the previous month, and share some insights on what we're looking at, and hopefully give you a few takeaways. And as ever, if you have any questions or you're looking for follow-ups on any of the information that we've covered in the session, just reach out to us. So please feel free to do so. So in relation to Symmetry Financial, again, I'm not going to talk an awful lot about us because hopefully you're familiar with who we are at this stage, and the fact that we are based in Dunboyne and we've got a national coverage with regards to our staff. Okay, so this morning we're going to just give a little bit of an update on what's going on in the markets. Going to talk a little bit about cryptocurrency. We're getting asked about it more and more. It is an area that we personally both have an interest in. So for full disclosure, obviously, for a percentage of an individual's assets, and I'm just going to talk a little bit about that in relation to your own personal investment choices and where you can go to get more information. And obviously you can come and talk to us if you want to have a look at it in more depth. We're going to talk about ETRs, or exchange traded receivables. Again, putting more and more money into ETRs as an alternative to cash on deposits, where, as most of you will be aware, you're getting zero return from the banks. And if you're lucky enough to hold enough capital, not only are you zero, you're probably been exposed to negative interest rates at this stage, which is what the institutions are actually facing on a day-to-day basis. So then James is going to have a little look at alternatives and the impact on alternatives with regards to what's going on with the likes of data coming out of Israel, the financial markets, crackdown in China. So very interesting noise or news coming out of China, and then we'll wrap it up and see where it takes us. So the funds update is actually going to be the first point, right? So that should actually be at the top of the agenda. So in relation to the funds, we're not going to go through the data on all the funds. What we do want to do is just month on month, we're going to just pick one or two things to focus in on. This month, I'm going to talk about the better performing funds, and this is in the lower risk category, as identified or defined by the fund managers themselves. So whether that's Zurich, Irish Life, Standard Life, Aviva, New Ireland, etc. And what we're focusing in on here are the lower risk funds as of the end of August this year, talking about Irish Life and Standard Life My Folio Market 2 fund. So why do we focus on those two? Because as of August, they've been the best two performing funds based on the last 7 years activity. So we're basing this back to June 2014. So we've got a good track record of data there. You can see obviously last February, every one of those funds had a particular pullback. The severity of that pullback is dictated or identified by the investment assets that make up the fund. And more commonly the term we'd use there is the volatility within the fund. Okay, so why is that relevant? Because if you look at the two best performing funds, they also happen to have the highest volatility. Now, why is that relevant? Because if you're investing in a fund that is designated or defined as being lower risk, are you comfortable with the fact that there may, at a particular time in the past, obviously, but also going into the future, there could be drawdowns in the region of 10, in this example, Standard Life's My Folio 2 fund had a max drawdown there of just over 13.5%. So you have to be a comfort with these potential types of drawdowns if you are going to be investing in some of these funds as designated by the various fund managers. So it's just more as an FYI. Again, we can talk about this in relation to specific funds, which is all individually as and when you want to engage us. In relation to the medium risk funds, again, the outlier there, the top performer and one of our favorite funds in here for our medium risk investors has been Zurich Life's Prisma fund. It has outperformed all of its competitors in that particular medium risk category, and its drawdown has been actually there or thereabouts in comparison with its competitors. So if you compare it with Standard Life's Active 3 fund, which has a higher max drawdown over the equivalent time frame, Zurich has still outperformed it by a significant percentage. So again, those of you that have dealt with us in the past and continue to deal with us know we are favourable towards Zurich in terms of how they actively manage their multi-asset funds. Okay, and then you're into the higher risk category. Again, the one that is leaps and bounds ahead of its competitors, again over the same time frame. In this asset class, you do have some of these funds have a much longer term performance, so you can actually look back longer than just the last 7 years. But some of the funds that we are comparing it with have only been around for that time frame, hence why we're limiting it to that 7-year cycle. And it's the International Equity Fund from Zurich, which is out there, and the max drawdown again is, it's an acceptable drawdown, to be honest with you, based on the performance that the fund has provided. Okay, so that's just a snapshot of 3 or 4 funds for this month, 2 of which fall under the Zurich management, 1 falls under under Standard Life, and 1 falls under Irish Life. So again, depending on your risk appetite, where you fall on where you think you fall on the risk spectrum. And then it's also time frames, whether you're investing a lump sum or whether you're investing regularly. It all will dictate what approach you take with regards to these funds. Okay, into the crypto market. So what are we talking about in the crypto market? Well, Grayscale are leading the way. So Grayscale are a gigantic investment firm. There's no other way to describe it. You're talking about tens of billions of dollars assets under management, with a particular focus on digital currencies, so the crypto market. The other companies then we're just going to touch on, because people are asking us, how do you select coins, how do you select the currencies to invest in? There's absolutely no crystal ball, unfortunately no crystal ball available. You will be looking at, if you do get into it, you look at performance of particular currencies or particular coins, and they're up 100%, and then you're looking at another coin and it could be down 10%. Why is that? Again, based on where the money flows are going, to be honest with you. So how do you identify where the money flows are going? Look at the big players. So the big players obviously would be Grayscale. Then there's another couple of players there, FTX.com and Bitwise. The reason why we like FTX.com is they've launched a couple of indices, which we'll talk about very briefly. And Bitwise, the reason why we like Bitwise is Bitwise have, I suppose, a team of heavy hitters behind them, and that's what attracted us to looking at Bitwise's activity. No other than the ex-CEO of ETF.com, so exchange-traded-fund.com. There's a website there, and the ex-CEO of ETF.com is now involved in advisory and I believe a chief officer role, chief investment officer role, I think it is, with Bitwise.com. So a guy called Matt Hoban. Again, you can check this out on their website yourselves. And then a couple of ETFs which you can invest in that particular space. So with regards to Grayscale, that's their assets under management as of the end of August. So significant holdings there, obviously in the Bitcoin Trust and in the Ethereum Trust. It's also of interest to note that Grayscale are playing to the SEC's regulations in terms of how they report. Obviously, the idea behind this is that their trusts or their funds would ultimately go down a road where they would become ETFs, exchange-traded funds, with obviously regulated within the SEC and approved by the SEC within the US market, which opens the investment options or opportunities to a much greater market, in particular the pension fund market, so the 401k market, which currently doesn't have access to these assets. If and when that changes, you can pretty much say it's good game over. If it happens, obviously, it still remains a highly volatile asset class. However, the likes of Grayscale are treating it like they would any other asset, and it is of note. It is of interest to our listeners here this morning. FTX, why are FTX of interest? Again, we like what they're trying to do. Again, with FTX, a trading platform, you can trade any of the currencies, futures, etc. But they've also gone and created indices. They have an altcoin index, they have a mid-cap index, and they have a shitcoin, or whatever word you want, an S-coin index. Pardon the language. This morning you didn't log on to hear us cursing. But they have 10 coins in the altcoin, 30 coins in the mid-cap, and then 50 coins in the lower value coins. It is of no, again, people are asking, how do you select which coins to potentially invest in? Well, these guys have gone, and no more than Bitwise and Grayscale, they've gone and actually identified the coins as part of these indices. Okay, so it is worth having a look at. Bitwise have been doing something similar for quite a while now. So they've got the 10 crypto index, which would be predominantly Bitcoin and Ethereum. Then they've got a 10x Bitcoin crypto index, which will be the predominantly Ethereum, followed by 9 other coins. And then you have their DeFi crypto in 10 crypto index. And that's all about the world of finance, or how would you explain it, James? What would be the
yield farming,
yield?
staking.
Yeah,
It's lots of it's a whole kind of
it's a disruptive
Pandora's
market.
box.
Yeah,
Yeah,
it's a
it really is.
disruptive market. Yeah. Basically moving away from what you would call traditional financial institutions to this DeFi market, where you can buy and trade and transact without the requirement of what's called fiat currencies, so the dollars, the euros, yens, etc. And that's what people are predicting will be the next big thing. So that DeFi market. Okay. In relation to the two ETFs that we have access to for regulated investments, and why would that be relevant for pension money, for example? So if you came to us with 100,000 euros and you wanted an exposure 10% of that, or would probably have to be a minimum of 10%, I think, based on the minimum amounts. But you want to get exposure to Bitcoin. There's an ETF there registered on the Frankfurt Stock Exchange, and there's also an Ethereum ETF, same thing. And you can see there, we have just given the performance or the track record. So there was a significant pullback in the cryptocurrency market in July, August, and then there's been a bit of a recovery, or a significant recovery then, starting in early August, which you can see there in the charts. But any of you that have an interest in this space will be aware of that. Okay. Okay, so moving on then, before I hand it over to James, into the exchange traded receivables. So when I'm talking about ETRs, what are we basically talking about? We're talking about credit exchange. Okay, so credit exchange is a platform that provides invoice discounting or invoice factoring, albeit on a scale that isn't comparable with similar providers out there. The reason why they do it a little bit differently is the companies that they target to pay the invoices. So if I'm supplying company X with bottled water or pens or food products, clothes products, whatever it might be, anything basically that you buy on a day-to-day basis. So if I'm the supplier, I can sell my invoices to this exchange only if the company that's ultimately going to be responsible for paying that invoice is of an investment grade quality, and that's identified or decided by AIG, and whether or not AIG can provide that credit insurance. Okay, so they have to be credit insurable companies. Why is that relevant? Because companies who are credit insurable by the likes of an AIG are of a significant size. Again, we'll talk about this in more detail and give examples of who these types of companies are in future briefings. But needless to say, from an investor's point of view, they have levels of risk reduction factors that are in place, outside of the fact that AIG would be one of the decision makers, or their credit insurance policies would be one of the decision makers as to who can get access to their exchange. The other elements would be the fact that they have a 4-tier protection support in place, obviously underlined then, as I said, by AIG. They're paying currently a 3% interest rate, so that's an annual rate, which is extremely competitive when you compare it with bank deposits, which, as we've just touched on, are zero. Any gains are a capital gain base, so if you make a 3% return on that capital that you invest, you are looking at a capital gain return to you. Why is that relevant? Well, if you have your annual CGT exemption of 1,270 euros, and if it's a joint application, it's 1,270 euros each, you can earn your 3% and pay very little tax, if any tax, on that gain, thus pocketing the full 3%, as opposed to 3% with a bank, if you were so lucky, would attract dirt. And then the other form of tax would be, depending on what you invest in, for a government bond, for example, would typically be income tax, which would be as high as 50%. Okay, so what you're trying to identify here is not only can you invest and get a low return, but a low return with very, very low risk, you also have favorable tax treatment of that return. The other reason why we like it is the liquidity on the investment is extremely liquid. James, the most recent encashment we did took how long?
Days, and I
Days.
mean they are quite quick.
Yeah. So they advertise it on the basis that it is I think it's a 60-day cycle to encash or redeem your investments. But in reality, our experience has been far from that. It's been, 5 to 7 days to get access to the cash. There's no breakage penalties. There's no early redemption fees. Basically, what you've earned of the 3% is what you get. So if you've invested for 6 months, you'd have 1.5%. If you'd invested for the full 12 months, you'd have the full 3%. It's a maximum term of 12 months, so you can't tie yourself in for longer than the 12 months. But again, it's of interest for those of you that have cash out there and that are looking for alternatives. Okay. Now we're going to pass it over to James, and he's going to talk a little bit about what's going on in the bigger picture.
Yes, definitely. So thanks, Mark, for that. Is really interesting on the funds update and on crypto. So what I'm going to be talking about today is alternatives, some COVID data, unfortunately, and then finally a little wrap up on China. Okay, so first slide. So we're going to be talking about the uranium market, and this is a really interesting market / opportunity for investors. So we're going to break down a couple of the key points or the key bits of data relevant to the uranium market. So the big takeaway here is you can just see the supply and demand imbalance projected as we move out into the late 2020s and 2030s. It's pretty stark. It's about 10% of all electricity that we use comes from uranium. And as I'll show you on the next slide, the spend, whether it's production, drilling, exploration, it's just all trending down. So there was a high point in 2008, and that's just moved lower and lower and lower throughout the years. So I suppose that would be referred to as capex or capital expenditure. When that goes down significantly and demand stays the same, typically what you'll see is an increase in the spot price. So here you can see, I suppose, the long-term price of uranium. And we have had prior spikes in price before. We've had a number of years of consolidation, I suppose, with the demand staying the same, but the supply getting worse and worse as the time goes on. And then I suppose look at the actual shares or how you can get exposure to the play. So, the uranium market is volatile. It's had multiple bear markets and it's had multiple bull markets. So the first share was CCJ Cameco, which is the second largest producer. They produce about just shy of 20% of the world's uranium. Mainly their mines are in Canada, and they would be regarded as a larger cap. So they'd be quite big. Whereas this share here is Paladin, which is based in Australia. They have mines and operations in Namibia. And again, you can just kind of see the volatility, the huge bull markets, the huge pullbacks. And I suppose, when it comes to investing or, putting your money anywhere, you're trying to go in with a margin of safety. And when you just look at the prices over the long run, it definitely, you can definitely see that the prices are on the floor and it could be a good place to put your money for, say, a 5 or 10-year period, because the fundamentals continue to improve. So I think like the key takeaway will be the miners cannot produce uranium profit at a profit. So I think spot price would need to double from where it's currently trading at for miners actually turn a profit. So the supply is just continuing to get worse and worse and worse. But the simple fact is 10% of all our energy comes from nuclear, and that's just not going to change. So definitely a really interesting investment, I think, for the next couple of years. So you can even see on the 1 year, Paladin Energy is nearly up 5x, and it's continuing to rise. Okay, so now we're moving on to basically the COVID data that's coming out of Israel. So Israel, kind of similar enough to the UK, was first in, I suppose, when it came to vaccines and getting everyone vaccinated. So I suppose they're the leading indicator for the rest of the world. I know it's not going to follow lock and step, but really you can just see that. So in the middle, at that middle peak there, was when the vaccines were really starting to get administered. And as you can see, the case numbers really came down. But now that I suppose life has went back to normal in Israel, I'm not gonna, it's very clear to see here that they've shot right back up to their prior peak. The scary thing is also deaths, and it's not on this slide, but hospitalizations and ICUs are also up. So I suppose what does that kind of mean for the rest of the world, and how it kind of plays into the financial market. So it definitely does play a role into the financial markets. So we have here on the left, which is the treasuries. So if you can look here at the chart, treasuries were actually going down in value, and yields were moving higher, as people were going back out into the workforce, as we were having the vaccines being administered. Because usually when this goes down, it's showing that growth is picking up in a significant way. Now, obviously, this bottomed out in March, and has been moving higher, which would kind of show that growth is now slowing. And then also it's to highlight the correlation between debt and the Nasdaq. And Nasdaq could be, it's a really good way to sum up financial markets as a whole. So Nasdaq, cryptocurrency, they're all really related to each other. And then I suppose this one here is quite interesting. So this would be the Chinese Nasdaq. Let's say that. And it's down probably about 50% from its highs. So it actually came into the year on a really strong footing, along with emerging markets and Asia Pacific. They were outperforming for the first 2 months, and then it's been a pretty downhill, to say the least, from there. So this has really just been off the back of heightened regulation in the tech space within China. And I suppose it really just undermines investors' confidence in the area as to whether they want to continue to invest in the sector. For instance, we don't have a slide showing the share price, but there was some publicly traded educational companies that the Chinese government deemed they were now non-profits. So the share price, went down about 90-something%.
Tanked.
So it's a really interesting pointer just to see where does this end, and the undermining of capital markets within China.
James, just one question before we wrap it up for those that have listened to this far.
Mhm.
In relation to uranium, where will the demand come from?
Okay, so the demand will come from the utility companies. So a very interesting point. There is no supply. Well, I mean, there is supply, but there's very little supply to dig up out of the ground. They don't have the money to do it. So if you look at Japan, they're already starting up there, I believe, 60 to 70 nuclear reactors. So obviously
they were turned off as
they
a
were
result of the
that's correct. So
Fukushima.
with Fukushima, they've been turned off. This is another catalyst for the spot price moving higher, which is those reactors are now being turned back online. There's been new reactors built in Poland. But really, it's just the existing utility companies. They want to get prices of uranium at a good price, and they want to lock in the good price. So they have to tap the spot market to fulfill their
Yeah.
contracts.
Start buying it. And then in relation to one of the stats you gave me about the cost of energy usage in what were the two? Was it Germany
Versus Arizona, yeah.
as the state of Arizona? Yeah. So just trying to explain that to those that have listened in this far.
Yeah, so I suppose uranium kind of gets a bit of a bad rap. Now there's obviously externalities involved with uranium that aren't good. In Germany, they've actually stopped their nuclear reactors by and large. They've done away with it. They want to move to solar. But in Arizona, they have a huge usage of nuclear reactors, and it's actually only increasing. And Germany now has one of the highest electricity costs in the world. Compare that to Arizona, it's extraordinarily low. So the initial cost for reactors, etc., is very expensive. But once it's there, these things can last a very, very long time.
Yeah, notwithstanding the actual risk associated with the energy itself. So yeah, again, it's something we're going to pick up particular topics. Maybe next month we talk about solar.
Definitely.
So we could talk a little bit about solar because there's a few investments out there in that play. We could talk about the energy from waste, which is the incinerator concept. Again, controversial in this country, but not so in other territories, because you have waste, we have to get rid of it. And the other thing we could maybe talk about next month is wind energy. So that would give a balanced discussion, in the energy space. But the reason why we're bringing it to the table is the market has moved. It's starting to move. We've shown you where it's been at its peak. It's nowhere near. It's still at, even though it's, the couple of companies James has identified at 5x year to date, this still would be in the infancy in terms of the actual spot price of the product. It is very much an alternative play. Equally so, in relation to Asia Pacific, we get clients asking us about Asia Pacific regularly as a basket of assets to invest in. The take there is, with the Chinese governmental involvement in the equity markets, which there's no other way to summarize it. They're pretty much getting their hands stuck in, and you don't need us to tell you what the press will tell you what's going on. Jack Ma, isn't that his name?
Jack Ma, yeah.
Jack Ma, yeah, the Alibaba guy, who just happened to go missing for a few months at the end of last year, I think it was. So all of this plays into how risky or not that asset class is, but not, again, you can't discount the fact that the market is down approximately 50% year to date. So for those that are risk on, there might be an appetite there for some exposure. Okay. Again, this is all obviously outside of the core fundamentals for most people's portfolios, which will typically be multi-assets, mutual funds, type ETF, exchange trade funds type investments.
So yeah, that was my bit. And myself and Mark would just like to thank everyone for watching. And if you have any kind of questions on anything that we talked about, get in touch, look at the website, schedule a meeting, and me and Mark are always happy to help.
So that's it for this morning. Thank you very much for listening. If you stayed the full course, reach out to James or myself. There's our email addresses. You can ring the office, obviously. And if there's anything that we've touched on that you would like us to delve deeper with you on, we'd be delighted to do so. Thank you very much. And James, thanks a million again.
Thanks,
okay, guys. Talk to you soon.